Hello, good morning. Today's top trading thoughts with my cohorts, Jason De Lorenzo from Adium Funds. Jesus, Lex. And then Mark
Not even
Phillips.
close, Lex. Not even close.
I know, we'll get it. I swear I'll get it. And then Mark Phillips from Harvested Financial from all around the world, Mr. World Traveler. Hey guys, good morning. What's going on?
How you doing, Lex?
Good morning, Lex.
We're all so excited. It's like 8 in the morning or something like that, and we've got babies to take care of, and everyone's sleeping. So a couple of things this morning. First thing from one of our past episodes on, I believe it was VIX SPX, the effects of gamma bunching, let's call it, lack of a better term. A viewer asked, I thought that customers bought out of the money calls and sold out of the money puts, which is sort of the opposite of what we indicated in our show. So I think I have an answer a little bit, but I just thought I'd throw that out to you guys and say, how can we, explain what we're talking about there?
Okay, I'll take this one. So between all of the insurance companies, annuities, everybody who is hedging, mostly big institutions, they use options to hedge. And hedging means buying puts. And so there's a lot, and basically what they're trying to do is they're trying to hedge their large portfolios of all different stocks, and they boil it down to hedging via liquidity risk in SPX options. So basically, the customer is the insurance company, is the annuity providers, is the large hedge funds. That's where the term comes from, and they are buyers of puts. Call sellers are usually those same entities trying to offset the cost of those puts by trying to gain premium on the upside of calls. As a result, you'll notice that put premium, IV, is higher than call IV, even though the market for the past several years has basically gone in a straight line up. You would think that calls would be more expensive, but they are not, because options are primarily used for hedging.
Okay.
Something else, though, to note, that on some individual equities, stuff like Tesla or GME, you'll notice that a lot of people buy calls, and that's more for speculative purposes.
Right. Okay, that makes sense. That's kind of where I was going to go with it. This viewer could have seen some activity in something like GME, some of these meme stocks where people are taking those lotto tickets out of the money calls, looking for massive binary sort of moves, and buying that sort of stuff. So that we get, and what's also becoming popular with the retail world is cash secured puts. So they're selling puts, cash secured, I can say it, so that they can be long, collect premium if nothing happens, and they're not afraid to take delivery of the stock on the long side because they like the stock. It's just something that they've done some research on. So they're probably doing a little of that and maybe a little confused of what we're referring to.
Yeah, a lot of times too with cash secured puts, that has been an increasing volume of options. But the thing is that a lot of times, because there's not as much, because there's more people selling puts and they become liquidity providers in options, what happens is it doesn't become worth it. Like if you just set a limit order as opposed to selling a put, and the stock drops and then comes back, you would end up losing money technically, because all you can gain is the premium. You have a limited gain but a maximum loss, because if the stock goes to zero, you lose your whole cash secured part of your cash secured puts.
Right.
So I think a lot of times when it comes to cash secured puts, which is a popular, it's kind of like collecting better interest, waiting for a stock to fall. So part of that is, it's a good thing. It's a nice strategy, but it's not as, you have to make sure that the premium you're getting is worth the risk that you're assuming.
Right. That's
Definitely.
true.
And I think there's a whole dynamic about what a customer is these days. That typically, there's you think of the dealers and you think of the customers, but really that, section of customers is a really broad base. And I think, Jason, to your point about the SPX and who the real large institutions are there, those sound like professional players, but to a market maker and to the market in general, those are customer entities. If you want to talk about some of the active players in a name like Lexa, GME, or where we really started to see that call skew. Tesla's another one. That might be actually a combination of the hedge funds and the, Robinhood, quote unquote, traders. But the composition of in those names, that's where you saw that gamma squeeze incident where everyone's buying the upside calls, and the predominant players in that name are of a much more short-term speculative, retail type composition.
Yeah.
Right. Okay.
I mean, I was going to talk a little bit about the market volatility that we've seen and how options have played a big part in it, and how you can almost have seen. So the market recently, I mean, it's been going up and down, and it's been, I think since last Thursday, it's been very volatile on the downside. And the headlines have been about inflation and about Russia about to take over Ukraine. But also this week is OPEX, option expiration, and volatility expiration, VX futures expiration. And a lot of this volatility that we've been seeing has been set up by under hedging prior to Thursday. We were under hedging for about a week and a half. We collectively, as a market entity, has been under hedged for everything. And so as a result, we've been seeing these huge swings, mostly drops, over the past several days. Today, upon the close, is VX futures expiration. I guess it's tomorrow morning, right? Technically. And, we saw a pre-market bump. But the whole time since 2 p.m. yesterday, we've been seeing a lot of volatility has dropped considerably, like about 7 points. The thing is that the over-VIXing and under-VIXing, we're expecting an event, whether it's inflation and Fed related or it's Russian related. And most of the times when you see these events, you always see a rally pretty much after the event happens or doesn't happen. Most of the time, like when Biden got elected, you saw this massive rally, even though, it didn't matter whether Biden or Trump would have gotten elected because we were so over-VIX, which means the VIX. You can almost say over-VIXing mean over-hedging. And over-hedging would be bullish because as the market calms down, the implied volatility of the puts that were purchased also comes down, and the market makers have to hedge by buying. Typically, that's the standard. But recently, between Russia and inflation, we have not been seeing the levels of over-VIXing or, hedging that we needed to see this huge move up. There's a paper also that talked about how hedging increases when you cross below the 200-day moving average of the SPX. That has happened, but it still has not been enough. So I think that market volatility and downside will persist until we see more hedging from market participants.
Okay, interesting. Mark,
so in a lot of ways, and I think you mentioned this a little bit on Twitter, so I'll give a shout out to Jason's Twitter feed. It's not just on these Tuesdays that you hear from him talking about this. Every day he gives amazing insight into that. I know I read it and I track, what's going on with that. But you mentioned how, futures are up 55, 60 points, something like that this morning, kind of on the relief of this Ukraine-Russia news. And, backing off of, 8% of the troops or something like that. And so the event that took place this morning or late last night or whatever it was exactly, that's sort of the precipitating factor that lets the air out of the balloon, and all of a sudden Vanna comes in and gets to do her magic.
Yes. However, there, in my estimation, with the over-VIXing kind of stuff, I don't think we were hedged enough. But there was a bit of hedging for the past several days, especially after the cross down below the 200-day moving average. But it kind of all burned off in the pre-market. And I'm honestly expecting, I guess you would call it a gap fill, SPX dropping down. Even if it doesn't happen today, it'll happen, pretty soon, especially after this volatility expiration, which honestly has been kind of an enigma for most people. Variance swaps, which are an institutional product that it's basically a realized volatility bet, they have been more muted recently because of those large intraday swings, but low close to close realized volatility. And so they've had to stay muted during this time. And we're beginning to realize that had to drop from that 30 level, I guess, yesterday, down to like 25 to match that variance swap unwind tomorrow morning. And so there's a lot of dynamics going on here with vol and with options that I think could cause another downdrift, if not today, tomorrow, and a gap fill, and maybe even further until we hedge again. And I think we'll hedge again probably when we pass yesterday's overnight lows. I think we'll hedge strongly again. But yeah, I mean, I think, or if Russia attacks Ukraine, I think then we'll see a large amount of hedging, and unexpectedly, and people, CNBC types will be baffled, but we will bounce after, the initial shock of Russia attacking Ukraine, or a 50 basis point increase, or whatever it is. So I think that's what to look out for, is what level of hedging do we have against these events? And if it's more, then we'll bounce. It doesn't matter what the event is, what happens with it. But if it's less, then the downside is always kind of open, and you could expect the market to react the way you would expect it to upon the event.
What other major global world events are out there that
Mardi Gras for
overhedge? Say again.
Mardi Gras for Lex.
Besides that, which is we've discovered March 1st, a Tuesday, March 1st. So that is a big.
You're 2 weeks early with the beads still.
I know. I'm gonna keep going with the beads. No. So what else is out there? Obviously, all that's on the news is this Russia thing.
Well, I think the other thing to watch out for is the contagion from Chinese real estate defaulting. You notice that the Chinese markets have been going down quite a bit, and that has an impact on us, even from a liquidity standpoint. The Chinese economy is something to watch out for.
Yeah.
Obvious, but nobody's paying attention. So.
Yeah, no. So someone is, is paying attention. The guy whose name I can't pronounce. It's the Prime Minister of China. He's paying attention to what we're doing with the Ukraine, because he's going to go grab Taiwan when it's convenient.
Yeah, that's what they're saying.
Fingertips.
That's what they're saying. Japan was saying that this morning.
Right. When did we become such a political show?
I don't know. I'm starting to feel a little bit out of my depth here.
Yeah. Oh, me too. Well, my God.
Well, I'm not saying politics. I'm talking options, man. I don't know.
Well,
whatever happens.
Yeah, quite frankly, politics does affect options, and that's the best part of it. We loved chaos on the trading floor, so the wilder the better. And now, since we have a guy like Jason who understands, where these hedging zones exist because of gamma and vanna, I wish I'd known that back then. My gosh, I would have bought lows and sold highs all the time instead of the other way around.
I don't know. Don't kid yourself.
All right. Those were some great ideas. Unbelievable. I love it. Anywho. All right, guys. Well, you be good. I'll talk to you soon.
All right. Take it easy.